Welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen, bringing you the latest developments and trends from the real estate and mortgage sectors here in Ontario and across Canada. Today, we're diving into some significant updates in the housing market that you definitely need to know about. The Canadian Real Estate Association, or CREA, has recently revised its housing market forecast for the rest of 2024. Despite the Bank of Canada cutting interest rates several times this year, the anticipated gradual improvement in the housing market hasn't quite materialized. Instead, CREA is suggesting that the market is entering a holding pattern until next spring. According to CREA's latest projections, approximately 468,900 properties are expected to be sold this year. While this represents a 5.2% increase from 2023, it's a notable downgrade from their July prediction of a 6.1% increase, and an even bigger drop from their April outlook of a 10.5% rise. This adjustment comes on the heels of their recent release of national home sales and pricing data for September. In September, the average price of a home sold was reported at $669,630, marking a 2.1% increase from the same month last year. However, CREA has tempered its expectations for 2024, now forecasting only a 0.9% annual increase in home prices to $683,200, down from its previous outlook of a 2.5% rise. Interestingly, home sales in September saw a 6.9% year-over-year increase, yet only a modest 1.9% rise month-over-month from August, despite the Bank of Canada's third consecutive interest rate cut. Toronto-based real estate agent Develle Morrison noted that buyers aren't rushing into the market as quickly as some might have expected. She shared that selling condos is taking longer than desired, with buyers seemingly more cautious. The number of properties listed for sale across Canada was 185,427 at the end of September, which is up 16.8% from the previous year. However, this figure still falls short of the historical average of around 200,000 for this time of year. New listings did see a 4.9% month-over-month increase, largely driven by gains in major markets across the country. Looking ahead, CREA is optimistic about a sharper rebound by next spring. Sean Cathcart, CREA's senior economist, highlighted that sales have increased for 3 consecutive months following interest rate cuts, albeit not in a headline-grabbing fashion. He suggests that the quicker-than-expected pace of rate cuts might lead some buyers to delay their purchases, potentially setting the stage for a more robust rebound in 2025. The Bank of Canada has lowered its key rate by a quarter percentage point 3 times this year, bringing it to 4.25%. With another interest rate decision looming on October 23rd, Governor Tiff Macklem has hinted at further cuts, given the progress in curbing inflation. Economists like Robert Kavchich from BMO are suggesting that by next spring, mortgage rates could become more attractive, which might finally invigorate the market. CREA is forecasting a 6.6% increase in national home sales for 2025, alongside a 4.4% rise in average home prices to $713,375. Despite the potential for lower interest rates leading to higher prices, real estate professionals like Develle Morrison believe that buyers may remain cautious, having learned from past economic environments. Today, we're diving into the weekly Mortgage Digest to explore why lenders have been hiking rates recently. If you've been shopping for mortgage rates over the past week, you've likely noticed an upward trend in fixed rates. However, the latest wave of increases seems to be stabilizing as Canadian bond yields have eased by about 15 basis points in recent days. The recent round of hikes was driven by a combination of factors. Market volatility following the United States jobs report, a surge in oil prices, and banks seeking to protect their profit margins all played a role. But what exactly is going on, and what can today's mortgage shoppers expect next? Last week, the United States posted stronger than expected employment numbers, with 254,000 new jobs created compared to the 150,000 that markets had predicted. This surprise raised concerns that the Federal Reserve may have overreacted with its recent 50 basis point rate cut, casting doubt on the need for further aggressive cuts. Ron Butler noted that a number of United States bank economists expressed skepticism that the Federal Reserve would cut aggressively in the new year, suggesting that treasuries had overreached. This led to a surge in treasury yields, which in turn pulled up Canadian yields. The 5-year Government of Canada yield rose roughly 14 basis points to 3.10%. Dave Larocque of Integrated Mortgage Planners pointed out additional factors influencing the market, including last week's war-linked surge in oil prices, which temporarily heightened inflation concerns and complicated the broader narrative of declining inflation trends. He mentioned that, despite central banks' efforts to ease interest rate pressures globally, the recent spike in bond yields caught many off guard. Larocque added that bond yields tend to spike unexpectedly, forcing lenders to quickly adjust fixed mortgage rates to keep up. However, these changes do not always reflect actual shifts in borrowing costs, as a lot of the time, it's more about protecting profit margins than following the bond market directly. In another perspective, rate expert Ryan Sims of TMG The Mortgage Group criticized the big banks for widening an already high spread between bond yields and mortgage rates. He argued that banks chose profits over people, stating that lenders could have absorbed some of the increase in bond yields, but instead passed the costs onto borrowers to maximize shareholder returns. As a result of these rate hikes, there has been a surge in rate hold requests, with many Canadian borrowers rushing to lock in their lower rate quotes before they expire, according to Ron Butler of Butler Mortgage. However, Butler noted that this spike is likely to be temporary as bond yields stabilize, and the Bank of Canada continues to lower its policy rate, which impacts variable rate mortgages. Butler's advice to borrowers facing renewal is to consider variable rates. He emphasized that the Canadian economy is in decline, and he anticipates that the Bank of Canada will keep cutting rates. This could make variable rates a more attractive option for borrowers in the near future. Now let's talk about why now might be the perfect time to jump into the housing market. According to Nick Lecuyer, the principal broker and founder at Mortgage Wellness in Barrie, Ontario, the current market conditions present a golden opportunity for potential homebuyers. With the Bank of Canada in the midst of an interest rate cutting cycle, many would-be buyers are sitting on the fence, waiting for rates to drop even further. However, Lecuyer argues that this wait-and-see approach might cause them to miss out on favorable conditions that are already here. Lecuyer points out that the focus on central bank rate cuts has overshadowed the significant drop in bond yields, which has resulted in lower fixed mortgage rates. First-time homebuyers on insured mortgages can currently access 5-year fixed rates as low as 3.94%, a substantial decrease from the best prime rates that might hover around 5.7% with a discount. This is a great opportunity for those looking to secure a mortgage, as these rates are already available, despite the anticipation of further cuts. The recent adjustments in mortgage qualification rules by the federal government have also played a role in shaping the current market landscape. These changes are intended to make home ownership more accessible, particularly for first-time buyers, by expanding access to 30-year amortizations and increasing the insured mortgage cap to $1.5 million. Lecuyer believes these measures will spark increased activity in the housing market by 2025, making now an opportune time for buyers to act. J.P. Botros, a mortgage sector advisor and FSRA committee member, emphasized that while these federal measures are beneficial, they are not a complete solution to affordability challenges. However, for those who can afford to buy now, it would be wise to take advantage of the current market conditions. The abundance of inventory, coupled with stagnant sales and lower prices, creates a favorable environment for buyers to secure properties without the pressure of multiple offers, and with favorable conditions such as financing contingencies and home inspections. Lecuyer highlights that the period between December 15th, when the new mortgage rules take effect, and the summer of 2025 represents a critical window for buyers to lock in affordable mortgages before the market heats up again. The ability to utilize 30-year amortizations can significantly improve affordability, especially outside of Canada's most expensive urban areas. For example, in Barrie, the monthly cost of owning a $600,000 townhouse has dropped from almost $4,000 on a 25-year amortization to $2,900 with the new rate and amortization, making ownership more attractive than renting. As the housing market continues to evolve, It's crucial for potential buyers to stay informed and seize opportunities when they arise. The current conditions offer a unique chance for many to enter the market under more favorable terms. As always, consult with a knowledgeable mortgage broker or financial advisor to explore your options and make the best decision for your circumstances. That's a wrap for today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found these insights helpful as you navigate the ever-changing landscape of the housing market. Remember, staying informed is key to making well-informed decisions. Thank you for tuning in, and we'll catch you next time with more updates and insights. Until then, take care and stay informed.